So we were discussing about the cash flow statements, and today we are about to start the direct method. So let's discuss how to make the cash flow statement with direct method. Okay. So the following are common components that appear on a statement of cash flows presented using the direct method. So first you need to find out the cash collected from customers. This is an inflow. This is a very important component of cash flow from operations. Then you need to calculate cash used in the production of goods and services. This is the cash outflow. Then cash operating expenses such as salaries, example has been given, rent, etc. Then cash paid for interest, that is the finance expense. Then taxes. So I will tell you one thing, you can remember this in this way. Revenue, okay, cash collected from customers. So you can see, you can put customers, you can put production, you can put operating, you can put finance, you can put taxes. CPOFT, some kind of mnemonic, some type of easy way to understand. Okay. So next step is you need to start with the top of the income statement. So only one figure comes in the top, that is revenue. Then you need to take the assets and liabilities from balance sheet, which are current assets and current liabilities typically, and which are connected with the income statement. For example, if I speak about revenue, revenue can be of two types. One is cash revenue and one is a credit revenue. That means credit sales. The credit sales in balance sheet will be written as receivables. Hence, receivables is connected with revenue, right? Which is one of the income statement items. In the same way, purchases are, related to payables. Then you have to compute the changes in the balance sheet items. We will, while doing practically, we'll understand. Then you need to adjust the income statement for change in balance sheet amount using the following rule: subtract an increase in an asset, okay, and like add a decrease in the asset. Okay, so see what happens. You need to subtract an increase in asset, okay, and you need to add decrease in asset, okay, because when the asset decreases, you are selling the asset, you get cash inflow, okay, and when you purchase the asset will increase, and then you need to pay cash for that. Okay, so increase in asset is decrease in cash. So decrease in cash has to be subtracted, and decrease in asset is nothing but sale of asset is increase in cash. You need to add. Next. Then again add an increase in liability. See what happens when there is some payables of $10,000 already, and you have again purchased some 5,000 worth of goods. Of course, you are not going to pay this 5,000 immediately right now. Okay, so when the liability increases, it is increase in cash. That means the cash is not paid. Okay, and decrease in liabilities, when you are making the payments, it is decrease in cash. So these things you should remember. Then for these rules to work consistently, we must treat expense items as negative numbers, because expenses are outflow. After adjusting the income statement item for the change in balance sheet, asset or liability, move to the next item in the income statement. Then you should do one thing: ignore any non-cash charges. Depreciation is a non-cash expense. Gains and loss on asset disposal is a non-cash income or non-cash expense. So all these non-cash items you should ignore. A non-cash charge is any amount in income statement that is due to accounting treatment rather than actual cash flows. You have shown them as an expense in the account in the income statement, but you did not pay cash physically for any of these expenses like depreciation and loss on sale of asset. Then once all income statement items have been adjusted for accruals, total the amount to get cash flow from operations. That means you are making the adjustments from accrual concept to cash basis. What you're doing, you are converting accrual basis treatment to cash treatments, and then you are doing the total and you are finding cash flow from operations. So we'll do one question to understand properly. So CFO using the cash flow from operations using the direct method, use the following balance sheet and income statement to prepare operating cash flows using direct method. The company produces its financial statements under US GAAP. So first and foremost, yeah, while doing indirect method, I'll explain you the difference between US GAAP and IFRS. This is an income statement given to you. You can just have a look through. Now, they have given the revenue, they have given all the expenses, then they have given income from continuing operations, then gain on sale of asset, loss on sale of asset. You know already that these kind of things, this one should be ignored, this one should be ignored. Okay, then you have all the details given to you, and then you have balance sheet whereby current assets and current liabilities are relevant for us. Okay, now we'll move forward and see what to do. First, we will start with cash collected from customers. So cash collected from customers, how we will find out? So you will be taking the sales. Okay, the sales figure is 1,04,000. Sales figure is given to you as 1,04,000. See, I already told you sales can be cash sales or credit sales. Cash sales or credit sales. Okay. Now coming to the receivables. See, I told you, right, cash sales and credit sales, both it can be. So what is given in the income statement I have taken. Now I will go to the balance sheet and see my receivables. Why I am seeing my receivables? To know whether this year did I do some credit sales or not. Okay, so what is the receivables figure at the end of 2006? 9,000. This is the end figure, and this is the opening balance of 2007. And this year your receivables are showing 10,000. Your receivables have increased from 9 to 10. So increase in receivables, that means you have done credit sales of 1,000. So like increase in receivables is decrease in cash. Please tell me yes or no. Yes. So we will just subtract this increase in receivables. Okay, and then we will take the unearned revenue. See, we are dealing with cash collected from customers. So receivables is credit sales, and also we would be earning revenue from our customers after providing certain services to them. Till the time the service is not provided, it will be termed as unearned revenue, and it is related to the customers only. Okay. So we'll come here and we'll check one more current liability, because already we have seen the steps, right? We have to start with revenue. Let's see the steps again. Start at the top of the income statement with revenue. Examine balance sheet for any asset, that is current assets and current liabilities. So that's what we are doing here. So we will see the unearned revenue. Unearned revenue is a liability. So this is increase in unearned revenue is increase in cash. Okay, because 2,000 was your they gave you in advance, and this time they gave you advance of how much? 6,000. So 4,000 extra they gave this year. So it's increase in cash. So we add, we get the cash collected from customers. Okay, now one item is calculated. Now we have to go for the cash paid to suppliers. First item, cash collected from customers, is done. So cash collected from customers, you have to start with revenue. You have to look into receivables, and also if unearned revenue is given. If this is not given, only receivables is okay. Excuse me. So this is the sales, but we don't know whether this is cash or credit. So we take this and we understood that some credit sales has been made, and the credit sales have increased by 1,000. Okay. Previously my receivables were how much? 9,000. Now my receivables is 10,000. Okay. So increase, the receivables have increased by 1,000 this year more. That means actually I was supposed to receive 9,000 from customers. Now I have to receive how much? 10,000 from customers. So extra sales has been made this year, right? Extra credit sales. That means it is decrease in cash. So whatever the cash increase or decrease, we need to adjust. Why? Because we are doing the calculation of cash collected from customers, where cash is an important element. So we need to see the inflow and outflow of cash. So when we see receivables have increased. There is no inflow of cash here. The cash has decreased. So we are adjusting. And from 2,000 till 6,000, we have received 4,000 worth of unearned revenue. That means extra cash. So when cash increases, we add. So in this way, cash collected from customers is calculated. Next. Everyone clear? Shall we move forward?
Yeah, Jay.
Yes.
Yeah. Yes. Now cash paid to suppliers. First, we will go with COGS. I already told you we have to take that income statement item which is connected with payables in the balance sheet, and that is purchases, and purchases is a part of COGS. So COGS is given in the income statement. Okay. And then cash paid to suppliers. You deal with what kind of assets or liabilities when it comes to suppliers? Inventory and also payables. Okay. Now let's go ahead. See, COGS is opening inventory plus purchases minus closing inventory. Okay. So here we will check what data is given. So they haven't given purchases anywhere. They did not give purchases anywhere. Okay. Because now we need to find out purchases first. If we need to know how much cash we have paid to suppliers, we first need to find out the purchase figure or purchase amount. Okay. But purchases are not directly given, but we know that purchases are a part of COGS. Okay. Now COGS is equal to opening inventory plus purchases minus closing inventory. What we can do here is to find out purchases, COGS minus opening inventory plus closing inventory is equal to purchases. Okay, you have got the formula. Now okay, now we will go ahead. This is one of the formulas. We will go to the balance sheet now. Okay, and there we will check the inventory. See, inventory previous year was 7,000. Now the inventory is 5,000. Okay, what has happened? The inventory has decreased. See, your aim is not to find out purchases through accrual concept. Your aim is to find out purchases as per the cash basis, what cash has come and what cash has gone out. Okay, this is, don't make any mistake. You are not following accrual concept to find out your figures. You are following cash basis to find your figures. So here when I speak about cash basis, I have to see inflow or outflow of cash. So what I'll do, I will go here and I'll see my inventory. My inventory has decreased from 7 to 5. Decrease in inventory is nothing but I have sold 2000 worth of inventory, that is increase in cash. So increase in cash is 2000. I need to add. I added, and COGS is a negative figure. So once I do this, my purchases are 38,000. Okay, because decrease in inventory, what happens is this is my this is my last year's inventory. So 7,000 is my opening inventory. Okay, my opening inventory, and my closing inventory is how much? 5,000. Okay, this is my closing inventory. That means 2000 worth of goods have been sold. Okay, okay, and 2000 worth of goods has been sold, and 2000 worth of money has been realized. Okay, so opening inventory purchases we have put in the formula, right? Let's check. Opening inventory is purchases minus closing inventory. COGS is 40, right? Yes. In this way also we can calculate the purchase figure. That way also we can calculate. This way also we can calculate. But I would recommend you to go with the cash basis only always. So 40,000, 7 minus 5 is 2. 2,000 comes here. You get purchases, and purchase is always a expenditure. So 38,000 is your purchase. Okay, in this way also you can. Now we will see the payables. Where are the payables given? My payables in the sense we are looking only at merchandise payables. Okay, that is accounts payable. Previous year I was supposed to make this much payment to my suppliers, now this much. My payables have increased, that means cash has not gone out, so that is increase in cash. We will add 4,000. Okay, so then when we adjust, we get cash paid to suppliers. So we got two things here. We got cash collected from customers, and we got cash paid to suppliers. Okay, have a look through these two figures once, please, then we'll move forward. Okay. Now we need to go for the next one. The format says we need to check the cash operating expenses. Cash collected from customers is done. Cash paid to suppliers is done. Cash, okay, because cash used in production of goods and services, that we need to check here. That depends upon what kind of company this is. So they have not mentioned any expenditure related to production here, like product manufacturing expenses, etc. So we can't find out the cash paid for production purpose. So cash used in production of goods and services, we can't find out that one because we have no input for that. Now we'll find out cash operating expenses such as salaries. Wages are a part of salaries, and other things are not given related to salary. Any other thing is not given. So we'll take wages 5,000, and then we'll look at the liabilities, whether wages, anything related to wages is given. Yeah. So this year my wages or wage expenditure is 5,000. Okay. That is in the income statement. At the end of the year, when I see the liability related to wages, I was supposed to make a payment of 4,000 to my employees, now 5,000. So extra how much? 1,000 my liability has increased. Increase in liability is what? Did you pay?
Excuse me, sir.
No, 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 no. Okay, okay,
Those are
okay, okay.
taxes
Got
It
it,
paid.
is
got it,
tax, sir.
got it, got it. Sorry, sorry, sorry. So 8,000 was my wages or liability. Now my liability is 4,500. That means my liability has decreased.
Yeah.
Liability has decreased. That means decrease in cash. I made the payments. So see the difference. How much will be the difference?
5,500.
3,500.
3,500.
Yes. So we will take that. Decrease in cash will subtract. Okay. So this is already expense. This is also decreased. So 8,500 cash paid to employees. Okay. 5,000 I'm showing as an expense and my liability also has decreased. That means I made a payment of 3,500 also this year. Okay. So 8,500 all in all cash has gone out. Next comes interest paid. So your interest expense you need to take from income statement and you need to check the liability related to interest expense. So that's what income statement item you need to take and also current assets, current liabilities related to that income statement item. Now interest it was 3,000, now it is 3,000. My liability has increased. That means I have not paid any cash. So 500 I will add. I added. I got interest paid. Now income tax. So this is the provision for income taxes given in the income statement. My tax liability and deferred tax liability. Hopefully, I think the liability has increased. Okay, that means taxes I was supposed to pay some amount and this year also I'm supposed to make some amount which I have not paid and my liability has increased. Increase in liability is increase in cash because I did not pay. So in both the cases I will not be paying the cash. You can check these figures. Why we took deferred tax liability? See, deferred tax liabilities this year current portion we need to take. Okay, taxes payable has increased, which means I did not pay the tax, so my liability has increased. And deferred tax liability like 15 and 20. Don't know why they are taking deferred tax liability here. We'll see the justification. The last item in the here we must adjust not only for changes in current liability for taxes payable but also for any changes in deferred tax assets and liabilities which are typically non-current items. Okay, so what you need to take precaution regarding the cash paid to tax authorities is what the aim is always is to settle our dues to tax authorities if at all we can settle in that particular year itself. So we saw that this much tax we need to pay. This is given in the income statement. So provision for taxes in the sense this much we have made a provision and we need to pay. And then we did not liability has increased. That means we did not pay cash. Deferred tax liability has increased. We did not pay cash. So cash paid for taxes is this much after adjusting. After getting all these figures, we need to put them. Cash collected from customers, paid to suppliers, wages paid to employees, interest paid, tax authorities, we need to pay this much. We paid this much cash in form of taxes. When we subtract all of them, we get operating cash flows. I would like you to go through this once again. Any doubts, please bring to my notice. I'm waiting fast. Okay, now let's enter into the next method, that is indirect method of cash flow statements. See, basically there is a small difference between, I will just explain the difference to you. See, direct method, indirect method. Fine. In direct method and indirect method, cash flow from operations and cash flow from operations aren't equal. But cash flow from investment activities or investing activities, cash flow from investing activities are equal. Cash flow from financing activities and cash flow from financing activities, cash flow from financing activities, both are equal. So what you understand is these two methods, when you make a cash flow statement based upon this or this, only these two are the differences. These two will differ in both the methods, and this investment and financing activities are almost same. Okay, so we need to learn the format for cash flow from operating activities in case of indirect method, because now we have done in case of direct method. We have already finished, right? We what did we do in case of cash flow from operations? Cash collected from customers
Customers. Yeah.
and cash paid to suppliers, as well as cash paid for operating activities. For operating expenses, you can take cash paid for interest and cash paid to tax authorities. After adjusting or doing a total of all this, we get CFO in case of direct method. But now we have to learn indirect method. Okay, it is somewhat complicated one. Please understand. So how you go about this method? So you start with net profit. You add all the non-cash expenses. See, our aim is to find what in indirect method? Cash flow from operations. But we cannot get cash flow from operations directly. First, we will start with net profit, which we will take from the income statement. And then we will convert the net profit. So what we need to do when we have to convert net profit to operating profit? All those expenses, I will just give you a small example. Just listen. So this is account. We start with revenue. Revenue is like, some X amount less COGS. You get gross profit less operating, administration, selling expenses. You get PBIT or operating profit. You need to come to this. Okay, now, so what you have done, just let's take some figures. 1 lakh, 10,000. Cost of goods sold is 2,000. Gross profit is 8,000. Operating expenses are 1,000. PBIT is 7,000, or operating profit or operating income is 7,000. Then add non-operating incomes less non-operating expenses, right? So we will get net profit. This is what we start our statement, our cash flow statement with. So now please understand, from up to down we have to come. We have to give this treatment, add incomes to incomes and expenses we need to subtract. But think, I'll take the figures. 2000 you are adding as non-operating income and 4000 you are subtracting as non-operating expenses. What are you getting? 7 plus 2 is 9. 9 minus 4 is 5. This is your net profit, right? I have been given net profit of 5000. I need to go from net profit to operating profit. How come I can go? Whatever I have added, I need to subtract. Whatever I have subtracted, I need to add back. Okay. Then only I'll reach to this figure, right? Yes or no? Please tell.
Yeah.
So whatever the non-operating incomes I have added to PBIT to move forward, and non-operating expenses I have subtracted from PBIT to move forward to get net profit. Now from net profit, if I want operating profit, I will have to do the reverse treatment. Okay. So see what will happen. So 5000 net profit, add non-operating expenses 4000 less non-operating nature incomes 2000. So 5 plus 4 9, 9 minus 2 7. So I got operating profit, yes or no? Yes. So this is what you need to remember. So we will do the same thing here. But extra items you need to learn. What are the extra items? We need to add all the non-cash expenses. Why we are adding non-cash expenses? You remember when you made income statement or profit or loss account, depreciation was a expense which you subtracted, right? Which as per the cash flow statement should not be subtracted because it is not a cash outflow. It is not a cash outflow. Okay, so we will add back. Add non-cash expenses like depreciation, amortization. Okay. So why are we adding this? You remember when you were doing the profit or loss account, you have subtracted depreciation, amortization, and you got net profit, right? So now whatever you have subtracted, you need to add back. And of course, these are certain expenses whereby cash is not going out. Okay. So add non-cash expenses, add non-operating expenses like interest less non-operating incomes. Okay. And then what we need to do, yeah, let's see the format. Yeah, this is what is the format. That's it, nothing more than that. Yeah, so this is add depreciation, amortization. See, I am any non-operating nature expense. So these are the non-operating nature expenses: loss on asset disposal, asset impairments and write-downs, losses on early retirement of debt, amortization of bond discounts, increase in deferred tax liabilities, losses of equity accounted associates. All these are non-operating nature expenses. This is a non-cash expense. Okay. And these are all non-operating nature incomes, all reverse of that: gains on asset disposal, gains on early retirement debt, reversal of impairment and write-downs. If there is an impairment loss, you have shown here. If reversal, it's a gain, you have to put it here. Amortization of bond premiums, amortization of discount is an expense, amortization of bond premium is an income, and decrease in any deferred liabilities or anything, you have to write it here. Okay, so all these are non-operating expenses and non-operating incomes. You have to add and then subtract. And see, interest paid here is a non-operating nature expense, but you should remember it is a cash expense. So we will again subtract that in like while going forward. Okay. Yeah, this is a non-operating nature expense. Interest payment is a non-operating nature expense. So first step is to convert the net profit to operating profit. So here you get operating profit. Then again you have to add and subtract changes in current assets and current liabilities. Add or subtract changes in working capital items. So increase in inventory. If you buy more inventory, it is decrease in cash, right? Increase in inventory, decrease in cash. And you should see, you should not take any item related to cash in case of cash, preparation of cash flow statements. So decrease in cash. So increase in inventory is decrease in cash. So you have to write it here. Increase in inventory. Decrease in inventory. You have sold inventory, so you got cash. Increase in cash. So decrease in inventory. INV is inventory. Increase in cash. So we add like that. Receivables also. Increase in receivables, decrease in receivables. So increase in receivables when you are not making, when you are not getting money from your customers, it is decrease in cash. See, increase in receivables means what? You are selling goods to your customers. Okay. Yes. So when you are selling goods to your customers, they are not making you the payments. So your receivables is increasing. So decrease in cash. Decrease in receivables, you get money. Increase in cash. Okay, like that. And then you need to take the liabilities. Increase in payables. That means you have not made the payments. Increase in cash. Decrease in payables. Decrease in cash. Okay, like that. After adjusting everything, you'll get some figure. Okay, then you have to less income tax paid, interest paid, because it's a cash expense. You get cash flow from operations as per indirect method. Please write the format, all of you. Okay, now let's go ahead. Everything has been explained to you. Okay, so we will make a like cash flow from operations we will find with the help of the indirect method. Okay, and then we will stop for today. Then tomorrow we need to do the final cash flow statement. We will be finishing this today. Let's take the same data and the net income. I'll just open it here. So we'll start with net income, which is given here. We will take this net income. Okay, this is there. Then we'll add non-cash expenses. So what are the non-cash expenses given? Depreciation and also non-operating nature expense, interest. Depreciation, these they are making as per US GAAP, I think. So in US GAAP, just a second. Okay, no, we will add it. Don't worry. We'll add interest expense 1000 here. You add that. Okay, don't worry. You'll get the right answer. And because in the format it is clearly given, losses on retire. Okay, fine. So we will always add the non-cash charges and also non-operating nature incomes. Okay, basically we do that. Fine. Okay, I'll do it and I'll prove the right answer for you. Don't worry. Okay, so I added 1000 and change in deferred tax liability also. So deferred tax liability was what actually? We have to account the changes. So deferred tax liability is here. It has increased. Okay. So when the liability has increased, it is increase in cash. We add. Okay. But this is non-cash charges. It is just increase in the liability. Okay. So we add all the non-cash charges like depreciation, change in deferred tax liability. Property, plant and equipment, if we dispose and if we, it is also a non-cash loss, non-cash item or non-operating nature item. So this 2000 also we add back. Okay, I told you, right? Add non-cash expenses and also non-operating nature expenses. So these are non-operating nature expenses. Okay, and then you have to deduct all the gains, like gain on sale of land, which is given in the question itself. Then add or subtract in the current liabilities and current assets. So again, they have here all the things properly they are put, and the total has come to this 43,000. Then receivables. See, you have to check the receivables. Receivables have increased. More credit sales has been made and we did not receive cash. Decrease in cash, subtract. Inventories have decreased. That means increase in cash. We have sold the inventories, add. Then there are only two current assets. Cash should not be taken. Overdraft should not be taken in liabilities. Accounts payable liabilities have increased. That means we did not pay cash. Cash increase in cash, add. Wages payable, the liability has decreased. We have paid cash. 3,500 subtract. Interest payable liability has increased, we did not pay cash, add. Unearned already you know 4,000, add. And increase in tax payable also we did not pay, add. Okay, so we get operating cash flows. This is the cash flow from operations as per indirect method. Okay, so this is the way you need to do the indirect method. You have seen the difference between direct method and indirect method. I want you to go through this topic once again today very properly, and tomorrow we will be seeing the investing and next class investing and financing activities, and we'll see the differences between US GAAP and IFRS, how they differentiate and how in a different way they give treatments to certain items. And then this will be the final class for ending up the cash flow statements. Okay, thank you all of you.